So, you have some money and you want to invest it. You've heard about buying and selling stocks, know that it's important, but you're not sure where to start. With all the noise from social media, friends, and family, it's easy to feel overwhelmed. But there's no need to worry because investing can actually be pretty simple once you understand the basics. And today we'll go over everything you need to know about investing as a beginner. This video is episode 3 of our Beginner's Guide to Personal Finance series, where we learn how to not be broke. If you missed our first 2 videos on budgeting and credit, be sure to check them out after this one. But without further ado, let's get started with today's topic, investing. So what exactly is investing? In the simplest terms, it means putting your money into something that you expect will earn you more money. You can invest in a lot of things: real estate, crypto, gold, even comic books or Pokemon cards. The list goes on. But in this video, we will focus on stocks and bonds, because for most people, this is the most accessible form of investing. You don't need a large amount of money, and it can be relatively low risk when done responsibly, especially compared to something like crypto. So to start, what is a stock? Essentially, when you buy a company's stock, it means you now own a little piece of that company. The value of your stocks is based on the market's perceived value of that company as a whole, but just split up into tiny little pieces or shares of stock. There are 2 ways you can make money from stocks. First is when the value of the stock goes up and you choose to sell it for a profit. And second is through dividends. Some companies, not all, choose to share a portion of the profits with their shareholders on a regular basis. For example, Coca-Cola pays out dividends quarterly, which means if you own some of their stock, every 3 months you would receive a payment from them, with the amount depending on how much stock you own. Simple enough, right? Now moving on to bonds. These are boring, so I'll make it quick. A bond is technically a loan that you give to a company or government. When you buy a bond, you are lending them money, and in exchange, after a certain period of time, they'll give you the money back plus interest. Bonds, especially US Treasury bonds, are generally much safer than stocks, but in return will potentially earn you way less money. It's good to have a balance of both stocks and bonds to even out your investment portfolio. Now that you know what stocks and bonds are, let's dive into how you can choose the best ones that will make you the most money. Spoiler alert, you can. Or at least you can do it consistently for a long period of time. Even billionaire Warren Buffett, who made his wealth from investing in stocks, says that most people should not try to choose individual stocks. There are just too many factors that can affect a singular company's share price, profits, global events, even a CEO's random tweet, making it impossible to consistently predict. So instead of trying to pick individual stocks, you can invest in an index fund, which is generally much safer. An index, in our case, is just a list of specific stocks, and an index fund is a pool of money that invests in everything on that list. For example, one of the most popular types of index funds is an S&P 500 index fund, which includes shares from the 500 biggest companies in the United States. If you invest in an S&P 500 index fund, you're investing in all these companies. You'll recognize names like Microsoft, Apple, Amazon, and Meta. Your investment is weighted based on the size of the company, meaning if you invested $1,000, you'll own about $68 worth of Apple stock, which makes up about 6.8% of the S&P, and $2.50 worth of Nike stock, which makes up about 0.25% of the S&P. By investing in an index fund, you're spreading your money across many companies, which lowers your risk and helps your money grow steadily over time. This is also known as diversification. The S&P 500 has had an average annual return of about 10% over the last 30 years. This doesn't mean it grows by 10% every year, but over a few decades, the average return works out to be around 10%. Let's take a look at this chart. All these dips indicate times that the stock market has declined. The dot-com bubble in the early 2000s saw the S&P 500 drop 49%. The Great Recession in 2007 to 2008 saw the S&P 500 fall about 57%. And most recently, the COVID-19 crash in 2020 was one of the fastest crashes in history, with the S&P 500 dropping about 34% in a month. Insane, right? And if you focused on just these dips, it's understandable you'd stay far away from the stock market. But let's zoom out. Notice anything about the chart? Yup, it all goes up. Every one of these dips have been followed by periods of growth. It just takes time. This also shows why you should never try to time the market. Instead, focus on regularly investing over a long period of time. No one can predict what will happen in the next year or even in the next month, but over the next 10 to 20 years, there's a good chance the economy will grow and the stock market will rise. Okay, now that we know why we should invest in index funds, let's look at how to invest in them. Step 1 is to choose where to invest. There are many types of accounts where you could invest your money, like Roth IRAs, 401ks, and individual brokerage accounts. Each account lets you buy and sell stocks, but they differ mainly in terms of when you're taxed and when you can access your money. And to be clear, these are not investments. They're accounts where you can invest. For simplicity, if you're a beginner, you could just start with a regular individual brokerage account on an investment platform like Step, or if you want, a Roth IRA with somewhere like Vanguard. Step 2 is to choose your investments. First, you could simply research the best index funds and bonds, choose the ones you like, and determine how much money you want to invest in each. This is a great option if you want more control over your investments. That being said, it does require more involvement and research on your end. Another option is investing in a target date fund. This is what I do, and it's a great option if you want to do the least amount of work possible and still receive great returns. Target date funds are a group of pre-chosen index funds and bonds that automatically adjust based on your age and risk tolerance. If you turn on autopay, you could literally do zero work after setting up an account and just cash in when you retire. It wasn't too complicated, right? Hopefully now you have a solid understanding of how to invest. We've covered the basics, but remember, the key to successful investing is patience and consistency. Start with small, regular investments and stay the course over time. If you have any other questions or suggestions on what we should cover in the next episode, let me know in the comments. And if you found this video helpful, give it a thumbs up and hit subscribe. Peace.